What's up? I'm Dan Fredenberg, and this is another Chance Encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon.
I understand that there are power lines that are getting kind of close.
What's up again? This is Dan Fredenberg, and that there is a commercial real estate building.
I'm joined today with Gabriel Einhorn. How you doing today, Gabriel?
I'm good. I'm good. Thanks for having me on. Appreciate you.
Oh, my pleasure. And you usually go by Gabe, that's right?
Yes, sir.
Excellent, excellent. And I got great news for you today, Gabe. I don't know if you're aware of this, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here? Well, obviously, because this is a chance encounter where I interview commercial real estate players. That means buyers, sellers, deal sponsors, investors, all that kind of stuff. And you might be sitting there thinking, well, why do you do that? And the answer is, if you've ever heard of the private off-market deals, or sometimes called 506B deals, then you really ought to know that the SEC gets ants in their pants if you don't have documentation of your prior substantive relationship, and they can take your business away in the form of rescission. That's bad. So I have people on here, and I talk about what's your core competency, your buy box, why are you doing it, and all that kind of stuff. And the benefit to you is you get to add another person to your list of investors and find out if my guest is a good fit for your organization. But before we get too deep into real estate, Gabe, do you want to say a thing or two about yourself?
Yeah. Real quick. Right now I'm financing commercial real estate, arranging debt financing across the country, both as a broker and with some in-house funds as well. Just going out, hustling, making new connections, and trying to help people get their projects and their deals to the finish line. So that's a little bit what I'm doing on the real estate side, and a little bit of a side plug for my clothing brand, faith-based clothing brand. Just trying to spread the importance of belief in God and prayer around the world through fashion. And that's a little bit about what's going on with me.
Beautiful. I love it. I love it. So you're a youngster, so you're probably pretty tech savvy. Or I'm going to go into the first segment here about motivations. But before that, I always got to say, but wait, check your rate. Gabe, I don't know if you can do this, but maybe you can check, you can look deep into the camera and into the user's device. Down there might be this big, hideous subscribe button. And maybe they should really ought to do something about that because, like, okay, it's a stupid joke, but I do it in every episode. And so
Gotta click it, right?
Right, exactly. Check your rate. Anyway, so the 5 distinct motivations. Now we've got all sorts of different people with their unique whys in real estate, and the fact is everybody is different in that sense. But when it comes down to brass tacks, I found that all of those different reasons are summed up pretty nicely and neatly in these 5 different categories. And the reason why real estate people need to know that motivation is because when the going gets tough, some people will throw in the towel, and it's that motivation that's going to make the difference and make them stick around. So the 5 different motivations, the first one of which is preservation of purchasing power. Some people, they earn more than they can spend, so they're always allotting a portion of their income to investment. Other people, they've already got enough assets or enough investments that they're work optional, that sort of thing. And they're involved in real estate, but the question might be, it's like, well, if you're in that sort of situation, then why would you bother making another investment? Well, the truth is you're going to be a lot more patient if you're in that situation. The biggest reasons why there might be some urgency or somebody will be inclined to pull the trigger, as they say. One is if inflation is eating away from the purchasing power of your nest egg, then it's going to be time to make another investment, another acquisition. And then the other one is when you get a steep discount, like when there's an asset crash. Now, of course, you should always try and get the steepest discount that you possibly can whenever you make one of these purchases. But the emphasis is that you don't have to make deals for deals' sake. You are waiting for those real great deals. Otherwise, you're not going to get involved. Now, full disclosure, this is not where I am in my arc of wealth building and real estate. What describes me a little bit better, it's fairly subtle, especially for youngsters, but I describe it as trading time directly for wealth. To give to color in the lines a little bit there, my background is in technology. That's what brought me into real estate. Specifically, it's the CRM space, and therefore it's online marketing and sales and building all those different funnels and fulfillment, all the tech stacks to do with that. And when I got to doing that for real estate companies, I realized that I was on the wrong side of the right business. There's plenty of money to be made, but the bigger thing that jumped out to me is that pursuing bigger and better paychecks comes along with much bigger tax bills.
Yeah.
And so basically for me, it stopped making sense chasing a higher salary. It made more sense for me to pursue deployed capital, aka equity, instead of those bigger salaries. So that's what I'm up to when in real estate. And I get that that's subtle for some people, especially a lot of younger generation, but of course present company excluded. But the more common reason why people get involved in real estate is they want to either fast track retirement, or at least they want to control their schedule a lot more. There are all sorts of promises made by different real estate coaches and all that kind of stuff that don't really pan out. But having more control over your schedule is one of the promises that are more frequently they're able to keep. And so that's something that's appealing to a lot of people. But there's one danger, which is that a lot of people who want to fast track their retirement, they think that everybody is secretly trying to retire and stop working. And I assure you that is simply not the case, especially in this industry. For example, some people are fueled more by ambition. They want to buy their entire hometown. They want that great big building with their name on it. They want the biggest yacht in the pier, that sort of thing. And even though that's vilified in some circles, you have to understand when it comes to commercial properties, somebody has to be sitting there with their hands firmly planted on the wheel, their foot on the gas, making sure that residents or whoever's renting the properties or leasing the properties is actually, those units are filled. You can't be asleep at the wheel is what I'm trying to spit out here. So that is one of the great parts of having people who are overly ambitious on your GP team. But of course, the other group that's going to hustle into their 90s, just like the ones that are doing it out of ambition, they're ones who've picked a sector of society, or maybe it's animals, the environment, who knows what it is, but they've figured out that there's a financial component to making a big impact, and so that's why they're making their real estate acquisitions. So, Gabe, as far as those 5 different motivations, what combination of those would you say describes you best?
Yeah, I mean, for me, it's control of my own schedule, I would say, is very important. I value my family a lot and my free time. I think those kind of mix together. So that's obviously the free time, as well as obviously building wealth, for the future of my family. I'm only 23, so I don't have a family of my own yet, but obviously, I have siblings, parents, grandparents, and, everybody older than me who's helped supported me. Obviously, I want to be able to get back to them as soon as possible, and then hopefully raise a family and have, the not only the wealth, but also the freedom to spend the time with them. So that's kind of my approach, and why I'm obviously very interested in getting involved as early as possible.
I love that answer. I'm fortunate enough to have been able to work from home through my children's youth, and I wouldn't trade it for the world. The fact is, that sort of relationship you build with your family, it's the best thing in the world. But it's so easy when you're talking about motivation to seem starry-eyed and optimistic. The fact is, there's plenty of risks in any type of investment. Real estate is definitely not outside of that. But if you've ever been involved in an off-market deal, the 506B deals that I'm I'm talking about, these private ones you're not allowed to publicly discuss, then whoever the securities attorney in the mix for the filing they should have insisted that every investor fills out what's frequently called a suitability questionnaire. It's a financial questionnaire, lots of invasive questions like your investment history, net worth, all that sort of stuff. But when I was filling out one of those for the first time, I found one question in particular, it lacked utility. Specifically, it was the tolerance for risk, and I felt that it didn't matter which of the options in the multiple choice question you chose. I didn't find it as informative that you could really take it to the bank, so to speak, or really understand a person's perception of risk. So I made my own version of the question for this show here, and it's a fill in the blanks question. It is, there are many popular investment asset classes, but I think blank is too risky. So Gabe, it can be inside real estate, it can be outside real estate, it can be both. What's too risky for you to invest in?
I mean, within real estate, it would be office. I think office space. I mean, I know it's coming up a little bit. People are getting a little bit excited about it coming back into play. I still think it's risky. I still think that, the world of technology, Zoom, it's still relevant and going to continue to be more relevant. So yes, there might be a little bit of an increase back into the office, but I don't think it'll ever go back to what it used to be. So I would definitely say that's too risky in regards to real estate. And then I would say sports cards outside of real estate. I have a bunch of buddies who are obsessed with, all these sports cards, getting the newest, rookie cards, football cards, and I'm like, I don't understand. Like,
Yeah. My take whenever I see that, or like Air Jordans or anything, it's like, okay, you understand appreciation, buy low, sell high, or else you lose, but you need a couple more plays if you're going to make real estate work. Which actually brings me to my next question. It has to do with favorite deal metrics. And to be brutally honest, when I did the first 100 or so of these Dan Does Deals Chance Encounters, I didn't include this one because I thought the question was a little bit too fastball for people who are on marketing or perhaps on the younger side of real estate. Maybe they're just the public facing side to try and bring people in while the pencil pushers, the spreadsheet jockeys are doing all the hard work, and people who are more focused on operations or construction, they're doing the more boring stuff. But I realized after a chunk of time that even if you are the front of house or something, you still need to be somewhat of a curator of deals. You have to say, okay, this is one that we should pursue or I should promote, and this one is not. And so the way you're going to do that is with some sort of deal metrics that you tend to rely on more than others. And for anybody in the audience who is only listening and not watching, I read out these 14. It's not an exhaustive list, but I read it out so that everybody in the audience knows what at least the ones that I'm suggesting are. And the first one is cash on cash. Second one is IRR, also known sometimes as equity multiple. It stands for internal rate of return. In other words, how many times your initial investment are they projecting that you're going to wind up with at the end of the investment. Next, there's cost per door. The next one is net operating income, or NOI. Then there's the going in cap rate, which really it's to help you compare to other commercial properties nearby where you're looking to make this acquisition, because that's a quick back of the envelope way to find out what kind of discount you're getting right off the bat. Then there's the loan interest rate, which is especially important if you're going to be assuming a loan. You're going to want to know what kind of interest rate you're walking into. Then there's the occupancy rate, which is the inverse of vacancy. Basically, vacancy is the enemy of real estate. You got to make sure that that's taken care of, but it's the same number, just inverted. Then there's the average income where the property is located. There's the amortization period of the loan, which is especially important if you're going to be assuming the loan. It's also indicative if it's going to be a hard money loan to start off while you're doing your capex and that sort of thing, or if it's completely stabilized to begin with. Then there's the difference between the market versus the in-place rents. So that way it gives you an idea of the appreciation right off the bat. Just like the population growth in the area where the property is located, related. If it's increased population, you're going to have increased demand, which is usually positive for pricing. Then there's the sponsor record, which is how many deals are on the go right now, how many deals have already gone full cycle. Then there's the waterfall, split, or exit strategy. In other words, what happens to your money after the investment is complete, it's gone full cycle. Basically, are you taken out of the deal? Do you get a reduced return, or what is that? And then the last one that I have on here is DSCR, which is the debt service coverage ratio, which basically means how much of the revenue is going out the door immediately in the form of paying for the loan. Now, once again, this isn't an exhaustive list, but Gabe, you want to give like a top 3, top 5 that you tend to focus on?
Yeah, for sure. I mean, so coming, on the lending side, I know obviously we look at a lot, like there's DSCR constraints, there's, loan to value constraints, stuff like that. But one thing that we've looked at a lot, and then I've kind of, taken for my own investment, criteria when I'm looking at my own deals to invest in, is obviously the story of the deal. It's not really necessarily a metric. Obviously, IRR is important, going in cap rate is important. Those are rates that, those are things that we always look at. But just understanding the story and the history of that property, what it's been through, who were the past owners, what's the rent roll and NOI, and what's obviously the population around it. It's important to understand the market as well. But I'm still, exploring and learning which metrics work best for me. But yeah, I would say probably IRR, cap rate, and then, on the lending side, obviously the sponsor record is important. Understanding, if the sponsor is capable of doing deals that he's doing right now. If he's doing a development, obviously it's important to know that he's done, prior developments as well. But just understanding this story, because there's always things that come up. Once you're going through the deal, oh, you didn't know that there's, a foreclosure on the property, or there's this problem, or there was, we had something that there was a murder on the property, 2 months before they were trying to buy it, and the whole deal fell through. So the story is always very important.
I love that focus on the nuance. I'm eating that up like a delicious subscribe sandwich. Is that intense enough for you? But
That's
yeah,
great.
that's always my big indicator that it sure is time for me to bring out the Dan Does Deals Commercial Core Competency Cube, which happens to be upside down. It's got the 6 different roles in a commercial real estate deal, and the idea is so that you in the audience, have a better idea of how my guest fits into these deals, so that you can figure out if they're appropriate to add to your organization. You'll get their contact information near the end of the show. But of course, as I'm going through these 6 different sides, you might be thinking, hey, how do I get my hot little hands on one of these cubes? Well, the good news is it's completely free. The way that you get a hold of one of them is you go to dandoesdeals.com, and there's this big conspicuous button that you can go ahead and download it for free. So I know that sounds really, really crazy that I don't ask for your email address or anything like that. It's a crazy, crazy thing that I'm up to. But the fact is, I want to make it as easy as possible. And if you see me looking distracted, it's because I'm trying to get that little dark space to move over the way it's supposed to. I don't know why everything got jacked up, but that's fine. Let's go through the 6 different roles, starting with the repositioner. The repositioner is the most public-facing person in a real estate deal. They are the deal finder. They do a bunch of different paperwork. They look at a bunch of different deals, and they have to underwrite the deal and have some sort of plan on how they're going to find more upside. Now, of course, what's that all entail? Well, the biggest thing is you have to find out is the property even making the amount of money that the broker/seller is claiming it is, because there are all sorts of fun and games that they can play with those numbers. But the most peculiar part about the role of the repositioner is they need to rub elbows with all sorts of financiers. In other words, people who are not operators, they're not involved with anything except for paper and money, and they only interact with the owners. So they're not an active part of the deal. Sometimes they're limited partners, sometimes they're banks, lenders in general. But the fact is, you need to have a lot of relationships with financiers in real estate, because it's so capital intensive, and also because because if you can secure a more advantageous loan, that goes straight to the profitability of the building. So that's very, very important, and it's important to understand. Now, of course, the next spot for the repositioner to look is in operations to stop those Benjamins from going down the toilet, of course. And of course, there's more to operations than just unclogging toilets and collecting rents and mowing lawns and all that sort of fun stuff. Me personally, when I have my GP hat on in a commercial real estate deal, the pieces of the puzzle I tend to contribute are to the tech stack based on my technological background. But also, one thing to understand is I said that operations, the vacancy rate is the deal killer. And so that means the GP team is going to need somebody in the fold who has some real marketing chops to make sure that even if you are outsourcing to a third party property manager to do your operations, they can step in and get those units filled. And those are the hats that I tend to contribute when I'm on a GP team for a commercial property. But of course, the next thing there's only so much wiggle room in operations, usually less than most people expect there's going to be because it's a competitive market. So the next place that a repositioner typically will look is they will get a contractor team involved to do renovations, make the place nicer so that the future residents will be happy to pay more in rent than the previous ones. But if only things were that simple. Of course, you can spend endless amounts of money on renovations. You can gold plate the toilets if that's your thing, but I don't think you're really going to get a good return on your investment. And somebody needs to keep an eye on these contractors to make sure that they're keeping the schedule and they're not using subpar materials and cutting corners in general. And I don't know if you know this about me, but I'm from the internet. So that means I rely on locals, boots on the ground, somebody who can be there in an hour or two, because you bet that's not going to be me. Because in an hour or two, I'd still be stuck at an airport. So you need to have somebody nearby who can spot check the operations and contractors, make sure they're not sloughing the photos and all that kind of fun stuff, and make sure that everything is running swimmingly. They need to have some sort of knowledge of all this kind of stuff. They don't necessarily have to know as much as the repositioner, but c'est la vie. Now, for the last role on the cube, it's best explained with a little bit of a hypothetical. Let's say you are a physician or attorney or an engineer. Maybe you have a few single-family rentals, and you get the idea in your head that, hey, there's a 350-unit apartment complex down the street, and I know how this stuff works. I just pool the down payment, and then I borrow the rest. And I betcha if I talk to my other friends at work or something like that, we each throw in 100K each or something like that, we could take that over. So full of confidence, you turn around to the financiers and say something along the lines of, hey, I want to buy that building. It costs tens of millions of dollars. You don't happen to have, say, tens of millions of dollars you want to lend us, do you? Well, there's one big thing that your real estate coach probably didn't tell you, and I encourage you to listen very carefully to before you jump the gun, which is the financier is going to ask you, who's your sponsor? Who's your KP? Now, KP is a somewhat uncommon term. It means the person who actually already owns a similar asset or at least has a significant enough balance sheet to show that they have that they're able to take that on that type of loan. Now, of course, part of the reason for that is because the financiers, the banks, they're not going to lend out depositor dollars to somebody who doesn't know how to run a 350-unit apartment complex. So somebody in the fold is going to have to own a similar asset. And then there's the collateral, the balance sheet that I was talking about, where it needs to be at least the amount of the loan. On top of that, you need to have a certain amount of liquidity. But if you have all those pieces of the puzzle, you got yourself a commercial real estate deal. So, Gabe, I know that you've got that financier background as a lender. I know that you're looking to get your feet wet as far as the actual investments goes. But I don't want to put words in your mouth. Which pieces of the puzzle do you see yourself taking up in your next deal?
Yeah, for sure. So the financier, obviously, that's what I'm focused on is helping finance deals, getting them the debt financing on all different deals across the country. And then on my own, I think it's a mix of like the repositioners and the sponsor, depending on the situation. Ideally looking for deals that I could be the main sponsor on, maybe the only sponsor on, and find maybe some off-market properties, some on-market, whatever it is, ideally in the New Jersey area. Um, and still obviously learning. So hopefully, can find somebody to help guide me to find the right property. I know there's no perfect property and been, starting to look just, the last year or so. And as many people as I speak to, they say there's nothing, no such thing as a perfect property, but obviously finding, the right one to, add to the portfolio and get things rolling. So a little bit of all that.
Perfect, perfect. So let's talk about buy boxes. When people are asking what's your buy box, we're asking about three different things. First one is location, which state, which county, possibly even which neighborhood. It's all definitely going to matter before you call
Yeah.
it ideal. The second one is size. Now, of course, in multifamily, we go by unit count. In other words, how many apartment units or how many doors are actually included in the property. And
Yeah.
the reason why it's relevant, why the size is relevant, is because the type of group that's going to be taking over 8 or 10 unit apartment complexes, they're going to be fundamentally different from the ones that are taking over 100, 150,
Yeah.
350 unit apartment complexes, which is why the size is important. Now, of course, other types of commercial real estate, they go off of square footage, for example, warehousing or industrial, that sort of thing, but that size constraint still applies. Now, the third one, though, I call desirability, but the more common term is class. I like the term desirability because it's really put into two different portions. The first one is the condition, and then the second one is the area. If you're talking about condition, you're talking about how old is it? How beat up is it? How recently has it been renovated? And then, of course, what sort of luxuries and amenities are included with that property that make it more desirable? That's the condition. Whereas if you're talking about the area, the crime rate is always going to be a consideration. But if you're talking residential, like multifamily, the school districts are going to matter. But the biggest part is the old broker trope of location, location, location. I don't like that little saying because what I think they really mean is traffic, traffic, traffic. If lots of people are passing by any property every single day, it's going to add to the desirability automatically just on that merit alone. So those are the relevant parts about area. But it doesn't matter if you're talking about area or condition, they use the same metric as in grade school to rank them, where you've got A plus at the top and then A and then A minus and then B plus and so on. So Gabe, as far as your sweet spot, what you looking for?
Yeah, so I haven't really honed in on an exact county yet, but state would be New Jersey. And class, I would say probably C or B, like some light value add work. Would like to do that. My family owns a furniture company, so we have some expertise in that sense to do some light value add to properties. And I would say if it's multifamily, 20 units and below. And for retail, um, also probably 5 million and below buy box. Those is kind of the range. I know it's still pretty wide and we still got to focus in a little bit more. But that's kind of the wide range now. And once I find the right property, then, focus in, let's say I find, a nice retail deal, then maybe just focus now only on retail in this specific county, but trying to, find the right deal within that wide range. And then once that right deal comes in, then that will be that'll direct the rest of my portfolio, I guess.
Beautiful. I love it. So let's talk people. Who are you disproportionately well suited to help? Me personally, it's because of my public social media presence and marketing and tech background. I tend to gravitate mostly towards the sponsors and KPs because they've got that foundation already in place where a guy like me can make a disproportionate difference. Whereas if you're trying to cozy up to repositioners, usually they need grunts, anybody who's doing startups, they need people who are putting in 80 hours a week. And
Yeah.
that's not where I'm the best contributor as far as an organization goes. But lastly, I need to add that everybody in this industry is ultimately in the job, the position of deploying capital. So anybody who is a financier, investor, that sort of thing, you're never going to see a real estate person that says, "Oh no, I'm not interested in investors right now. I've just got way too much capital for me to know what to do with." But Gabe, as far as you're concerned, who are you best suited to help?
So I could definitely help, sponsors and KPs on the financing side. Anyone who owns, invests, looking to develop, I can help them arrange debt financing. And then also on, maybe the contractor side, stuff like that. because my family's furniture company, we actually do the kitchens, closets, and vanities for some of these developments. So that's also another aspect. So yeah, I think a little bit of that.
Perfect. So I'm sure people are thinking, how on earth do I reach out? So I'll sandbag that for a moment and talk about myself. I'm fortunate enough to have this really distinct last name. It makes me ultra easy to find, especially on LinkedIn, which is the social media platform where I spend most of my time. So that's the best way to reach out. If you scan this code, that gives you some more ways to reach out. And basically, if you are interested in appearing on a podcast like this, or my more popular one called Chess with Investors, featured on chesswithinvestors.com, be sure to go ahead and check that out and let me know that you're interested in coming on there. Basically, we play a live game of chess while we're talking about investment and real estate and all that sort of fun stuff. But Gabe, if people want to reach out to you, what are the best avenues to do so?
You can find me on LinkedIn, Gabe Einhorn, getting pretty active on there, so it shouldn't be too complicated to find me on there. And then if you want to send me an email, GEINHORN at Capria, CAPRIA, GRP.com. And then my cell too, I don't mind giving that out, 201-759-7407. So would love to talk with anyone. Always open to new connections. LinkedIn's been a big part of that. That's how I met Dan, and just keep going. Appreciate you taking the time and having me on, Dan.
Beautiful. And that brings me to my public service announcement. It's not so much for you, Gabe, as the people in the audience. Yes, you that I'm talking to. If you've been watching this episode and experiencing searing pains in your eyeballs, maybe like migraine-like symptoms, I'm confident it's due to the downright hideous subscribe button that's just down there that you can get rid of for free. You just click on the thing.
Click it.
And exactly. And full disclosure, I want a whole whack of people to hit the button so that those deadbeats at YouTube actually start paying for these videos instead of
For
me.
sure.
I think that would be fantastic. And the trade-off to you is my videos may show up on your list of suggestions. Quite frankly, you can go ahead and ignore those suggestions. I just really appreciate the fact that you spent this time with me. Just like Gabe, I appreciate you joining me today. This has been fantastic.
Thank you, Dan. I really appreciate it.
Awesome. Thanks. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506B or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye.